Hello everyone, welcome to Journey to Trading. This video series goal is to introduce the basics of the stock market to individuals with no prior knowledge of the field. We're gonna go through the theoretical, conceptual aspects of the stock market before moving on to the more technical ones. Hopefully, if you stick around, you're gonna end up with some solid foundational stock market knowledge. In today's video, we will be discussing what a stock is, why people invest in stocks, and how people make money in the stock market. So, what is a stock? A stock is basically all the shares into which ownership of a company is divided. Now, not all companies that have stock are able to be traded by public investors, and so only companies that decide to go public are able to issue that type of stock. For those of you who don't understand what going public is, it is basically when a relatively healthy private company decides to undertake an initial public offering, also known as an IPO. And so, in order to do that, they usually have to hire an investment firm that will underwrite the offering and sell a number of shares to the open market at a good valuation price. Now, the important thing to keep in mind is when an IPO is successful, it is usually a pretty good indication that that stock is going to do well in the aftermarket too. Also, not all private companies with private ownership are able or want to become public for reasons such as not wanting to disclose their earnings, not wanting to disclose information about their operations to the SEC, which is the Security and Exchange Commission here in the United States, aka the government regulatory agency overseeing the securities market, again here in the US. Another reason why some companies are unable to become public is related to not having enough money to pay for an IPO, for the SEC registration fee, for the stock exchange listing fee, etc. And going back to publicly traded companies and why some companies want to become public, the main reason is usually to raise funds from the capital market to expand their businesses, develop new products, and even pay debts. Moving to the second section of this video, why do people invest in stocks? Two words, inflation and depreciation. With the average annual rate of inflation being around 3% since 1913, money not only doesn't hold its value, but the purchasing power of money decreases over time. Now, not all inflation is bad. Since the price of goods increases, businesses are able to make more money, and usually that translates in employees being better compensated. This being said, rather than leaving one's money to depreciate because of inflation, people invest in securities to protect against it and even to generate some additional profit. Now, one might ask, what about savings accounts? Aren't they the solution? Don't they offer some interest, like yield some interest yearly? That is correct, but unfortunately for average savings accounts, they are offered between 1 and 1.35% annually, which is basically half the average annual rate of inflation. Since the annual interest on savings account is not enough to offset the impact of inflation, and since historically we have witnessed a reliable annual return on investments equal to 10.72% between year 1992 and 2016, that's the S&P average, people are inclined to invest their money in the stock market to protect it from inflation. Moving on to the third and final section of this video, how do investors make money in the stock market? Given that this is a basic introductory video to the stock market, I'm only going to go through two fundamental ways investors make money. The first one being profit sharing and dividends. Profit sharing is basically when a company makes profit and it distributes that among shareholders proportionally to how many shares each one has. Some investors are interested in companies that offer profit sharing and dividends. However, it is important to note that not all companies offer profit sharing, even when they are making profit. Instead, many companies choose to use that profit to expand their operations and pay down their debts. Now, why would an investor want to invest in a company that doesn't offer profit sharing? The answer is capital gain. If a company that turns consistent profits decides to use its profits to expand instead of distributing it amongst its shareholders and it is successful, there will be more demand for that stock, leading the share prices to go up. So, the increase in share price from what you initially paid for it is what's called capital gain.